There is a playbook that gets executed before every market collapse. This is not a theory. This is not a strategy that works sometimes. It is a mechanical sequence that the wealthiest investors have followed before every major crash for the past 100 years. 3 specific moves. Always the same 3. And right now, as we speak in 2025, those 3 trades are being made again by the people who matter most. Joseph Kennedy saw it coming in 1929. 6 months before Black Thursday, he made 3 specific moves that turned the greatest financial disaster in American history into his personal fortune. While the market fell almost 90% and wiped out millions of investors, Kennedy walked away with $50 million. Paul Tudor Jones made the exact same 3 trades in 1987. When Black Monday hit and the market dropped over 22% in a single trading session, Jones pocketed $100 million in one day. Michael Burry, John Paulson, and a handful of others executed these identical 3 trades before 2008. They made billions, while the global financial system came within hours of complete collapse. These are not coincidences. This is pattern recognition. Market crashes follow a predictable sequence. Valuations reach extremes that defy logic. Leverage saturates the system. A trigger event appears. Forced selling begins. Panic takes over. The cycle is mechanical. And because it is mechanical, the response is mechanical. 3 trades, the same 3 that have protected wealth and generated massive profits before every crash since the Great Depression. And those 3 trades are happening right now. Warren Buffett is sitting on over $325 billion in cash, the largest cash hoard in corporate history. Ray Dalio has been warning about debt cycles and systematically repositioning. Bill Ackman made billions in March 2020, and he is positioning again. The smart money is not guessing. They are following a script that has been proven 4 times over the last century. Let me show you what these 3 trades are, how they have worked in every major crash, and why the fact that they are being executed right now means we are somewhere between 12 and 18 months away from the next collapse. Once you understand this pattern, you have a choice. You can ignore it like most people do and watch 30 to 50% of your wealth disappear. Or you can recognize where we are in the cycle and do something about it while there is still time. The reason it is always 3 trades, and not 2 or 5 or 10, comes down to the structure of crashes themselves. Crashes are not random events. They are mechanical failures that happen in phases, and each trade addresses a specific phase. Phase 1 is recognition. This is when sophisticated investors realize that asset prices have detached from reality. The potential gains no longer justify the risks. The math has stopped working. This is when you exit. You convert positions to cash, preserve what you have made, and get out before the destruction begins. Phase 2 is preservation. Sitting in cash protects you from market losses, but it exposes you to a different problem: currency debasement and inflation. Central banks always respond to crashes by printing money, which destroys the purchasing power of cash. So you need protection against currency collapse. That is where hard assets come in. Gold, specifically. Something that holds value when paper currencies and financial assets are disintegrating. Phase 3 is profit. You are not just trying to avoid losses or preserve what you have. You are positioning to make money from the crash itself. This requires instruments that pay off when markets fall. Short positions, put options, credit default swaps, bets that rise dramatically in value as the system comes apart. Execute all 3 together, and you have created perfect positioning. Trade 1 protects you from losses. Trade 2 protects you from currency destruction. Trade 3 makes you rich while everyone else is being wiped out. And then there is an implicit 4th trade that comes after the crash, using the capital you protected and the profits you made to buy everything at fire sale prices. But we will get to that. First, let me show you exactly how this is played out across 4 different crashes. Trade number 1 is the cash conversion. This happens 12 to 18 months before the crash. It is the earliest signal, the recognition that markets have reached unsustainable levels, and it is time to get out. In 1929, Joseph Kennedy was one of the most aggressive speculators of the Roaring '20s. He had made millions manipulating stocks through coordinated buying pools. By early 1929, Kennedy controlled massive positions across multiple companies. The market was in pure euphoria. Stock prices had tripled in 5 years. Ordinary people who had never invested before were borrowing money to buy stocks. Margin debt was at levels that had never been seen. Investors were putting down 10% and borrowing 90% to buy even more shares. But Kennedy understood something most people did not. When everyone is already fully invested and leveraged to the maximum, there is nobody left to buy. Markets do not go up without new buyers. And when prices start falling, even a little bit, all those leveraged investors face margin calls. The broker demands more cash immediately, or they sell your stocks to cover the loan. That forced selling pushes prices lower, which triggers more margin calls, which forces more selling. It becomes a death spiral with no way to stop it. Kennedy knew this pattern. So, starting in the summer of 1929, Kennedy began methodically converting his stock holdings to cash. Not all at once, because dumping everything would crash prices and ruin his exit, but steadily and systematically over several months. By September, Kennedy was substantially liquid. The Dow Jones hit its peak on September 3rd. The crash started on October 24th, 7 weeks after Kennedy had already gotten out. While ordinary investors held on all the way down, watching their life savings evaporate over the next 3 years, Kennedy sat in cash, protected, ready for the next move. Fast forward to 1987. Paul Tudor Jones was running a hedge fund that had been successful trading commodities and stocks. But by the middle of 1987, Jones was looking at market valuations and seeing massive problems. The Dow had climbed 140% in 5 years. Price-to-earnings ratios were stretched. Margin debt was surging again. And there was a new factor that nobody fully understood yet: program trading. Computers executing enormous trades automatically based on algorithms, creating instability that traditional markets had never experienced. Jones ran the numbers. He concluded that a crash was not just possible, it was inevitable, and it was coming within months. Throughout August and early September 1987, Jones systematically reduced his long stock positions. He converted everything to cash. He sent memos to his investors explaining that he expected a major crash by October, not a vague warning, a specific prediction, with a specific time frame. By early October, Jones was sitting almost entirely in cash and getting ready for trades 2 and 3. The market peaked on October 2nd. The crash came on October 19th, 17 days later. Jones was already out. Now, 2008 is more complex because different investors saw the housing bubble at different times. Michael Burry started moving to a defensive position as early as 2005. He stopped investing in stocks. He raised cash, and he sat on that cash while preparing for the other 2 trades. John Paulson reached the same conclusion in 2006. Warren Buffett, always the most cautious, had been building cash since 2006. When asked why he was not investing it, Buffett said he could not find anything worth buying at current prices. Translation: everything is overvalued. Time to get out. The market peaked in October 2007. By then, Burry, Paulson, Buffett, and others were substantially in cash. When the crash accelerated through 2008, they were protected. Which brings us to 2025. Warren Buffett is sitting on $325 billion in cash. Read that number again. That is the largest cash position in corporate history. Buffett has been systematically selling stocks to raise this cash. He cut his Apple position in half. He has been selling Bank of America's shares month after month. He is not buying anything. In his most recent shareholder letter, Buffett stated explicitly that he cannot find anything attractively priced. That is not a casual comment. That is a coded message. Everything is too expensive. Get out. But it is not just Buffett. Jeff Bezos has sold over $13 billion worth of Amazon stock. Mark Zuckerberg has been selling billions in Meta shares even as the stock hit all-time highs. Jamie Dimon, the CEO of JP Morgan Chase, sold company stock for the first time ever during his tenure. Insider selling across corporate America is at levels not seen since 2007, right before the last crash. These are the people running the companies. They see the actual financials. They see the real customer data. They know what is coming, and they are converting to cash. Trade number 1 is happening right now. The smart money is out. Trade number 2 is gold accumulation. This happens simultaneously with the cash conversion, usually starting around the same time 12 to 18 months before the crash. The purpose is protection against currency debasement and inflation. In 1929, after Joseph Kennedy converted to cash, he faced a problem. The government response to the crash was going to involve printing money and devaluing the dollar. Kennedy understood this. So throughout late 1929 and into 1930, as the crash was unfolding, Kennedy was buying gold. Not gold mining stocks, physical gold. This protected his purchasing power, while the dollar was being debased through government intervention. Bernard Baruch made the same move. When the dollar was devalued in 1933 by Franklin Roosevelt, Baruch's gold holdings increased in value by almost 70%. While everyone holding dollars lost purchasing power, Baruch gained. The 2008 crash is where gold really proved its value again. Throughout 2007 and into early 2008, while Burry, Paulson, and others were raising cash, they were also accumulating gold. Paulson specifically made enormous gold purchases. When the crash hit and the Federal Reserve responded by dropping interest rates to zero and printing trillions through quantitative easing, gold surged. It went from around $700 per ounce to over $1,900 per ounce. That is a gain of over 170%, while the dollar was being destroyed through money printing. Now in 2025, central banks around the world are buying gold at a pace not seen in decades. China, Russia, Turkey, India, Poland, Singapore. Central banks added over 1,000 tons of gold to their reserves in consecutive years. These are not retail investors. These are the institutions that understand currency debasement better than anyone because they are the ones doing it. Why are central banks buying gold at these levels? Because they know what is coming. When the crash hits, governments will respond by printing unprecedented amounts of money. The dollar will be debased, inflation will surge again, and gold will protect against that currency destruction. Trade number 2 is happening. The smart money is accumulating gold right now. Trade number 3 is the volatility bet. This is the profit trade, the move that does not just protect you from losses, but makes you wealthy by betting directly against the market. This trade happens closer to the crash, usually 6 to 12 months before, once the smart money is confident about the timing. In 1929, Jesse Livermore, perhaps the greatest speculator who ever lived, spent the early part of the year building massive short positions. Livermore understood crowd psychology. As 1929 progressed, he accumulated enormous short positions across multiple sectors. He was positioning to profit from every point the market fell. When the crash came, Livermore's shorts paid off spectacularly. He made over $100 million during the crash, equivalent to over $2 billion today. In 1987, Paul Tudor Jones spent the summer building his volatility positions. Jones bought put options on stock market indexes. Puts are contracts that pay off when prices fall. They are pure volatility bets. On Black Monday, the market fell 22.6% in a single day. Jones's put options went from being worth a few million to being worth over $100 million in one day. The 2008 version of Trade 3 is the most famous because of the Big Short. Michael Burry spent 2006 and 2007 buying credit default swaps on subprime mortgage bonds. A credit default swap is essentially insurance on a bond. Burry was betting that subprime mortgages would default in massive numbers. Everyone thought Burry was insane, but Burry understood the math. When the crash came, his credit default swaps paid off at levels that seemed impossible. He turned a few $100 million into several billion. John Paulson did the same thing on an even larger scale. His fund made $15 billion. One fund, one trade, $15 billion in profit. Now in 2025, the volatility bets are being placed again. Hedge funds have been accumulating put options on major indexes. The DX has been showing unusual activity. Sophisticated investors are buying protection at levels that suggest they are expecting a major move down within the next 12 months. Bill Ackman made $2.6 billion in March 2020 by buying credit default swaps right before the COVID crash, and Ackman has been signaling recently that he is concerned about market valuations again. The data shows massive increases in put option activity on major stocks and indexes. Someone is buying enormous amounts of downside protection. This is institutional scale betting. Trade 3 is active. Let me connect this to what is happening right now. All 3 trades are being executed simultaneously for the first time since 2007. That is the signal. Buffett is sitting on $325 billion in cash. That is trade 1. Central banks are buying thousands of tons of gold. That is trade 2. Hedge funds are accumulating put options and credit default swaps. That is trade 3. The playbook is being executed in real time. The historical pattern says that when all three trades are active, you are 12 to 18 months away from the crash. Stock market valuations are at extremes seen only twice before, in 1929 and in 2000, but it is worse because of concentration risk. 7 stocks represent approximately 30% of the entire S&P 500 market value. Nvidia alone trades at a price-to-earnings ratio that defies logic, driven by artificial intelligence hype. Real estate is more overvalued than the 2008 housing bubble. Commercial real estate is already collapsing, with office buildings sitting vacant. Government debt exceeds $36 trillion. The system is fragile. It just needs a trigger. Based on the historical pattern, here is the timeline. We are somewhere between month 12 and month 18 before the crash. That puts the crash window at late 2025 or the first half of 2026. When the crash comes, it will happen in phases. First, a crack appears. Then comes contagion. Then comes intervention. Then comes the secondary collapse. The investors who execute the 3 trades do not try to time every twist and turn. They position early. They build cash. They buy gold. They buy volatility protection. Then they wait. And then comes the implicit 4th trade. After everything is crashed, after panic has reached maximum levels, that is when you deploy. You use the cash you protected and the profits you made to buy everything at fire sale prices. This is what Kennedy did. This is what Buffett did in 2008. This is what Ackman did in 2020. The 4th trade creates generational wealth. So what should you do? Most people can't execute this pattern at the institutional scale, but understanding the pattern gives you an enormous advantage. You can execute simplified versions. Trade 1, raise cash. Reduce your exposure to stocks. Trade 2, buy gold. Allocate 5 to 10% of your portfolio to physical gold. Trade 3, buy protection. Use put options as insurance. The most important element is psychological preparation. When the crash comes, when markets are down 50%, when every headline predicts the end of capitalism, you have to be ready to act. You need the courage to buy when it feels like the world is ending. That psychological fortitude separates the investors who get rich from those who lose everything. The 3 trades are not secret. They are a documented historical pattern. They worked in 1929. They worked in 1997. They worked in 1987. They worked in 2008. And they are being executed right now in 2025. The pattern is repeating. The crash is coming. Position yourself while there is still time. Because when the crash is already happening, it is too late. The trades have to be made before. And before is right now.